Hey everyone, me Kevin here. In this video, we're going to talk about what the Federal Reserve just said about the stock market and debt in the markets. This is part 1 out of 3 parts of this series because we're going to talk stocks and debt in part 1, then we're going to do real estate in part 2 and crypto in part 3, all from the Federal Reserve. Folks, let's get into this right after I mention that this video is brought to you by The Daily Upside, a free business and investing newsletter sent right to your inbox every morning. All you have to do is go to metkevin.com/upside. It's totally free. Go to metkevin.com/upside and sign up for a free business investing newsletter. Okay, folks, let's get into the financial stability report. It is 85 pages long, and I'm just going to give you the straight bottom lines here, the straight scoop about the most important part. Here we go. Part 1, the overview. Folks, the Federal Reserve is consistently looking for risks in the market. Now, there are a lot of folks who like to leave comments on YouTube saying things like, oh my gosh, why are we always talking about the market crash? Folks, it is so important to know what risks are so that when they appear, you are prepared, you know why the market is reacting the way it is, and you have the opportunity to make money. For example, if you knew exactly what was happening during the March and April recovery, so the end of March and April recovery in 2020, you would have thrown a lot of money into the stock market, and that is exactly what I did. So I'm covering and watching the news every minute of every single day. I live and breathe this stuff. So when the Fed talks about risks, I pay attention. Now, I know not everybody believes them, but hey, best thing is, listen to their bottom lines and consider them. Okay, number 1, prices of assets, very, very high. Risky assets. Okay, look, in May of 2021, they did a financial stability report 6 months ago, and they said that basically stock prices were already very, very high compared to their expected future cash flows. Worth noting that they're not talking about high, like stocks are priced high compared to current cash flows. They're saying stocks are high compared to expected cash flows. That's a sign that's a little concerning. In addition to that, they suggest that asset prices remain vulnerable to, quote, significant declines should investor risk sentiment deteriorate, progress on containing the virus disappoint, or the economic recovery stall. Personally, I don't believe the economy stalling is a concern. I also don't believe that the virus is that big of a concern, at least at this moment, with the data that we're seeing and vaccination rates and so on and so forth. Now, the biggest one here is this right here. Should investor risk sentiment deteriorate, we could see significant declines. The Fed is basically saying the stock market is not going up for fundamental reasons. They're basically saying the stock market is up because people feel like stocks only go up. Stocks only go up. That's dangerous. That's risky, right? So these are important things to pay attention to. The Federal Reserve is telling us this. This is a warning. This is a red flag that says get out of margin. Do not be highly exposed to debt. Don't be exposed ideally to any debt on your securities, especially crypto or, oh my gosh, stay out of margin. Very, very, very dangerous. And instead, be comfortable taking a little bit of profits on options if you have options. Stow away a little bit of cash. And the good times are times to stow away some cash, even though the market was pretty red today. Market was probably red, honestly, partially because of this report. It's something to pay attention to. Now, borrowing by businesses and households has mostly returned to pre-pandemic levels, which is actually a good thing. A little note in here about some issues that small businesses had during September, not that big of a deal. And leverage in the financial sector like banks is actually pretty good, with the exception of life insurance companies where things are a little more elevated. Now, there's also a note here, which I thought was very interesting, especially since they're leading off by talking about sentiment leading stocks to be high. Take a look at this. Social media, retail investors, and equity trading was a report that was put together, and it analyzed the volatility in so-called meme stocks by linking changes in demographics, regulations, and technology to recent trends in the demand for and supply of retail trading opportunities in the market. And in other words, the Federal Reserve is now, and they're going to make some comments about this in a moment, the Federal Reserve is now looking into social media trends. Look at this, retail investors, social media, and equity trading as potential risk factors for financial stability. Take a look at this. To date, the broad financial stability implications of these developments have been limited, with bursts of retail trading volatility that have rapidly subsided. Right? It's that classic momentum stock pattern where we see this, then we see the decline, and then the bleed out. That right there is the sign. If you ever see modern art and you see something like that, folks, meme stock. Okay. All right. So let's keep going over here. So the revival of household financial risk appetite and stock market participation. Take a look at this one. Household financial risk appetite appears to be cyclical. And here the Federal Reserve is saying that people get interested in stocks in cycles. We hit a peak in 2001 and another peak in 2019 and a trough in 2009. So unironically, when people should have been most willing to take financial risks, which a financial risk is really just an investment, right? A calculated investment is still a financial risk. No risk would be, well, old days it used to be just cash, but there's obviously now inflation risk associated with cash. So really, no matter what you're doing, there's some form of financial risk. But generally, what they're thinking of here is when you take a financial risk, you're generally referring to investing. Like if you bought treasury bonds, technically those are supposed to give you your money back in the future. And if you were worried about inflation, you could buy tips. Although you're still paying a premium for those as well, so you're still going to lose a little bit of money. But anyway, getting off that tangent here, by 2019, in the most recent survey, it was again approaching a 2001 peak. And it's interesting to notice here that the household direct stock ownership appears to follow risk appetite to some degree. So as risk appetite goes up, more people are buying stocks. And usually risk appetite is going up when prices are going up. That's bad. That's dumb. That's the opposite of what we should be doing. When prices are going down, that's when we should be making the biggest investments. But before I go any further, you need to check out the Daily Upside. It's a free business and investing newsletter sent right to your inbox every morning. If you're like me and you're tired of all the clickbait financial news headlines and biased coverage of important issues by traditional outlets, starting my mornings with the Daily Upside helps me cut through all of the noise and have a better jump on the markets every day. It was founded by a team of career journalists and financial experts to better inform both retail investors and seasoned Wall Street professionals. And their goal is a lot like mine, to provide an interesting and insightful perspective on the biggest events of the day that won't put you to sleep or confuse you. It's a 5-minute read that isn't afraid to dive into hot topics and give real, high-level, unbiased analysis. And as someone who built a career around real estate and investing, I can't recommend it highly enough. Join the 150,000 readers and sign up totally for free by going to mettkevin.com/upside or by using the link in the description down below. All right, now let's get back to the Federal Reserve's report, because so far the Federal Reserve's report is basically saying, hey, like, debt levels are good, asset prices are really high. Yeah, we may have run the money printer a lot, but we're seeing a lot of especially younger folks take more risks than older folks. And the amount of younger people getting into stocks is substantially higher than it used to be. And it's an increasing trend. Now, there are good things associated with that, but maybe not if they're all associated with YOLO call options. So we want to be careful of that. But I want you to keep an eye on the trend of this financial stability report. They're saying prices are high. It's very risky to invest when the market is higher, and you should basically be safe with your investments by limiting margin and limiting debt. And that's what other companies are doing. With the exception of life insurance companies, a lot of companies are actually reducing debt. We'll see some more references to that in just a moment. Now, the report does go on to say that so far there is a little bit of a moderation in investment risk. Even though risk is overall trending up, we've seen a little bit of a pullback from the craziness that we saw in the springtime. And that's partially because we're seeing less IPOs and especially less SPACs, especially because of increased regulatory scrutiny on SPACs, which, keep in mind, those investor presentations they put together for SPACs, totally ridiculous. On payment for order flow, the Federal Reserve mentioned that payment for order flow has been pretty useful in getting people to invest in the stock market with free commission trades, right? And it's really come out of laws from 2005 and 10 that essentially led companies to be able to take a little bit of a spread every time you trade, as long as the customer receives, quote, the national best price or offer price or better. And this is where you get companies like Robinhood saying, well, you're getting the best price. Really? Is it really the best price? Or could I have gotten a share for 3 or 5 cents less, right? That's sort of the argument. But either way, overall, the biggest risk that the Federal Reserve sees when it comes to payment for order flow is actually options trading, because options trading is the most profitable for brokerages. This is where payment for order flow and the spread for payment for order flow is the highest, usually around 5 to 10 cents, as opposed to maybe 1 or 2 cents for stocks. So you could really see 5 to 10x the spread or potential profitability in options for brokerages. So they have an incentive to encourage you to trade options. Worth noting that, because options can be very, very risky. This is why, for example, somebody left me a comment earlier. They said, "Oh, Kevin, what happened to Mr. Never Sell?" I'm a big fan of never selling some of my deep, long-held share positions. But when I hold options, you go into options knowing that at some point you're going to sell. So if you know you're going to sell the options or roll them or whatever you're going to do, you may as well take profits when they're green. Act quickly though, because options move fast. You gotta have a good risk appetite for options. But anyway, take a look at this reference again, back to younger traders, the average age of account holders in trading apps being 30 years old, nearly half of them identifying as, quote, first-time investors in basically colorful apps like Robinhood. It's literally what they're talking about here. And get this is going back to that social media part. The widespread use of large open social media platforms has shaped how retail equity investors communicate about the markets. Recent academic papers have shown that social media can increase the information flow to retail investors, as well as the amount of noise in markets from retail traders. Social media can contribute to an echo chamber in which retail investors find themselves communicating most frequently with others of similar views and interests, thereby reinforcing their views, even if these views are speculative or biased. Folks, the Federal Reserve has never before talked so much about how young people, please pay attention, because you're all sitting in really stupid echo chambers paying way too much money for stocks, and you keep buying more of them when the price is going up, and you're stupid. You're gonna get screwed. Please at least just don't be in debt. Do what the other banks are doing and be out of debt. Which, in fairness, is very true. Folks, I've made 3 videos in my career about this company called Hyliion. The first video I deleted because I did not recommend people invest, and I don't make recommendations. I'm not an investment advisor, right? But I didn't recommend or consider Hyliion a good investment for myself. This was back when it was at $18 to $20. I said I thought it was a dangerous company to invest in. I had to delete the video and remake it. I made 2 separate videos breaking down why I thought there were risks associated with the company, and I was arming investors with information about, hey, this is what you got to pay attention to. This is a risk factor. This could hurt. Be careful. Watch this. And if I wasn't too careful, I was getting flamed by people who are basically only interested in Hyliion. That's because it's not their fault. It's how the algorithms work. Think about it. The algorithms will show Hyliion videos to people who like Hyliion. So the algorithms reiterate an echo chamber. That's dangerous. Like, somebody who hates Hyliion and doesn't care to invest in Hyliion is not searching Hyliion on YouTube. Anyway, they went from like $18 to $20 to $8 to $9. So worth noting, sometimes it's worth listening to alternative opinions. But anyway, I really find it fascinating how the Federal Reserve continues down this path about expressing risks about financial stability associated with individuals and social media. Kind of interesting. Otherwise, for younger stock investors, here you go again. I kid you not, they are just talking straight up to like millennials here. For younger stock investors, they tend to be more leveraged than older households. Median leverage ratios of younger retail investors are more than double of all investors, leaving those investors potentially more vulnerable to large swings in stock prices as they have larger debt burdens to service. Vulnerability is amplified as investors are now increasingly using options, which can often boost leverage and amplify losses. Folks, this entire report may as well just be called, Yo Millennials, Stop Being Stupid. This is, like, if you're watching this and you're like, dang, I'm really exposed to options. Dang, I'm really exposed to YOLO trades. It is okay to have some Apple, some Google, and some Amazon in your portfolio, okay? It makes up about 15% of mine. I consider it a solid foundation. It's the bottom part. It's a lot less volatile than like options at the extreme or YOLO bets, right? So be very, very careful with some of these. It's so weird how they keep referring to this. But anyway, let's keep going. So then we have business debt. Gross leverage is high, but net leverage, the ratio of debt less cash to total assets, has dropped since levels not seen in 2018. Again, good news for businesses, good news for companies, not so good for potentially retail investors like millennials who have a lot more debt. Credit quality, which deteriorated after the onset of the pandemic, has continued to improve. This is very good. Better credit quality, very good thing. Default rates on leveraged loans, these are basically subprime loans rebranded as leveraged loans, have fallen. That's good. And the financial position of many households has continued to improve since the previous stability report in May. Also very good. So you're getting a lot of good news about debt, credit quality, lower defaults. Look at this. 1/3 of household debt is consumer credit, which consists primarily of student loans, auto loans, and credit card debt. Inflation adjusted consumer credit edged down in 2021, and student and auto debt were flat, and credit card debt declined in real terms. That's actually really good. And the share of auto loans that were either delinquent or in loss mitigation declined further to about 3%. However, there's a little bit of an increase because of stimulus programs wearing off. But otherwise, the risk that student loan debt poses to the financial system appears limited, and consumer credit card balances have contracted on net. This is good. This is very good. But again, that reference to younger individuals having too much debt versus banks. Overall delinquency rates of loans held by banks fell during the first quarter. We also hear that hedge fund leverage associated with equity market activities remained at high levels in January of 2021, but we're actually seeing, even though we're at elevated levels, we're seeing a decline in hedge fund leverage. The black line here is hedge fund leverage, and we're seeing that start to decline a little bit. This right here is January, and this right here is now. So you're seeing that leverage at hedge funds come down. Again, another indicator that hedge funds and institutions are aware asset prices are very rich, and they're reducing leverage and potentially raising cash. Bank lending to financial institutions operating outside the banking sector continued to increase in amounts, but overall credit quality is still very, very strong. Then the Federal Reserve talks about what they think is actually one of the biggest risks to the financial markets, and it's actually cybersecurity. This to me is bullish for a company like Cloudflare. I really wish I invested in Cloudflare. I'll wait for a dip. But anyway, take a look at the 4 different risks they pose for cybersecurity. One example here is a cyber attack at a bank holding company that impairs user data. So this would be much worse than like Robinhood leaking potential names or dates of birth or whatever. It would be literally corrupting institutions' data and how complicated it could be to fix that sort of data. So that would be a risk. Also, a potential cyber attack of a stock exchange that could limit or halt trading, like what happened in New Zealand at the Kiwis for 4 days. That there could be a loss of confidence in the market if there were a cyber attack. Imagine if there were a cyber attack at the same time as you had some form of disastrous market crash. Like it could just amplify problems. It'd be horrible. You know what happens when people can't sell? People freak out and get more nervous. Number 3, financial institutions weren't the target of the SolarWinds attack, but some form of other financial institutions getting hit hard. This could, in my opinion, be something like a Citadel or brokers that handle trades outside of the exchanges. And a 4th risk would be potentially one of the big trading firms, one of the big banks going down. And in 2018, the Federal Reserve did a study on this and found that 31% of banking sector assets would face compromised liquidity outside of the affected bank if one of the 5 big banks went down. I mean, this right here is basically a blueprint for how hackers could really screw up America and American finances. But look, if we have a summary of this financial stability report outside of the other parts when I'm going to talk about housing and stablecoins and cryptocurrencies, folks, this report right here is a massive warning to younger investors who are using options as a large part of their portfolio or are in debt. And folks, if you want more insights into my opinion on how to properly invest, how to maybe modify the way you're investing, check out my programs on building your wealth, link down below, especially the Stocks and Psychology Money group. You get buy sell alerts every time I make a transaction, and I make it very clear if I'm doing something out of speculation, if I'm YOLOing, or if I'm making a long investment and I'm doing something to buy and hodl. So folks, I look forward to seeing you there. Thank you so much for watching this video, and we'll see you again in the next one. Goodbye.